right. All right. Welcome back to the Kansas City Commercial Real Estate Market Pulse, sponsored by Midwest Commercial Real Estate Advisors. If you're in Kansas City and the metro area, I'm sure you're getting pounded by rain right now. So hopefully everybody's staying dry. I got absolutely slammed earlier today, was soaking wet, but a little rain never hurt anybody. I'm joined today by Nathan Roberts. Nathan, how are you doing, man?
I'm doing well, man. I got a few leases that I'm sending out today, so that means I'm making some money this morning.
Rock on, man. Good work. Good work. We got a super exciting deal presentation for you here today. It's going to be kind of a little bit twofold, right? We need to get into some of the macro trends in the office and the investment sector, but also kind of the trends that are really we're seeing in Kansas City. Based off of that, we're going to be fielding a bunch of questions. So on that note, make sure you're dropping in your questions, your comments on the chat. We are live here for episode 28 of the Kansas City Commercial Real Estate Market Pulse. And I know that might not sound like a lot for all of you folks who are big podcasters out there and things like that, but it takes a lot of work to be able to get this stuff put together. So big shout out to our team, always being prepared and ready to go. Katie Cobb could not do it without her. Micah Beebe dominating on the multifamily side, as well as land. Nick Morales, we're doing all kinds of projects right now. Flex industrial developments. We got land. We're doing multifamily and residential land as well. Even a little bit of hospitality. Chad Kagi rocking it on the medical office side. And like I said, I'm joined by Nathan Roberts once again here on the Deal Spotlight. Nathan, you seem like you're a pretty regular here on the Deal Spotlight, man. You must be pretty busy. How you holding up with everything?
Yeah, I'm pretty busy. I mean, I'm holding up. I would say majority of the work just requires doing a lot of prospecting. Make sure you're following up and just keeping track of all the leads. That can be tough for any broker, but we have a great system in place to make sure that we're staying in touch with everyone that we connect with.
Awesome, man. Yeah, well, thank you for being here. Thank you, Manny, Caleb, Joshua. All appreciate you guys tuning in and dropping in some comments. Let us know if you have any questions as we are going through it. I'm monitoring LinkedIn right here. We got the YouTube monitored. Drop it in on the questions and comments, either in the YouTube or the LinkedIn. Look, I mean, we've been very active on the Kansas City Commercial Real Estate Market Pulse, and our whole aim, our focus is to try to be your go-to source for real-time data-driven insights into the Kansas City commercial real estate market. If you're not following us on LinkedIn, come and follow myself on LinkedIn. Head over to the newsletter. Make sure you follow the Freeman Factor Beyond Buildings newsletter. That's where all of our newsletter information is going out on a regular basis. We just dropped a Q2 market report, so you can go find that on LinkedIn, on the newsletter. Great resources over there. And we're going to be sharing some incredible information around the office investment sector today and presenting a great opportunity that Nathan and I have been working on for some time. Look, office has been, really this interesting conversation piece. And I think that where I'd like to start this presentation really is, while everyone is still debating whether office is dead, the smart money and people, I'm seeing this happen, are already positioning for the suburban and in some cases the urban office renaissance that's already happening right now. And so I think that office has been this unique component asset class that people have been trying to figure out for the last year or 2 years. But Nathan, I don't know what you've been hearing. You're saying you're signing leases. I know my wife has to go back into the office. What's the chatter around the office market that you're just hearing out in the industry as you're talking with businesses?
I mean, really, I think it depends on the industry in the business that's actually looking for space. Majority of, I would say, the office tenants that I've been working with have been a lot of therapist groups. So physicians, medical office. I mean, those are individuals that need a physical location in order to see their customers. Also, in combination with like flex or retail, I mean, these are still consumer-facing type of buildings and businesses. I would say for the most part, like if you're doing something with let's just say insurance or something along those lines, typically you don't require an office because no one's really going into the office to try to get insurance quotes.
Sure.
Typically you're gonna do that over the phone.
Absolutely.
Certain industries, I mean, even within industries, it really depends on the business.
Yeah, totally, man. Absolutely. Well, let's get into some of these macro trends that we are starting to see. And I mean, one of them being that institutional capital is flooding back in. This is from Cushman and Wakefield's data. The institutional and REIT office purchases are up 200% in 2024. They are up 200% in 2024. CMBS office lending was $11.4 billion in Q1 of 2025. And that is the highest since 2007. Look, why is that? Well, I mean, office cap rates are now 7.5% all the way up to 8.8% versus the apartments and industrial market, which are hovering around 5, 6, 6.5%, right? I mean, so you have this generational buying opportunity while fundamentals are starting to stabilize. And, institutional capital is really returning to the office sector. And I think a lot of private investors do watch what the big, 800-pound gorillas are doing in the industry so they can try to capitalize on some of that downstream opportunity, right? We kind of call it the Google effect. If they move their office building to a new market, we typically see a lot of real estate development and or other purchases around that, because that data that they are utilizing and those growth trends and demographic markers, they have some of the best analysts and access to the best data. If they're making a decision, a lot of investors are trying to kind of, piggyback on top of that, right? So the office sector is definitely starting to show signs of NOI stabilization, right? And I think that's important from an industry at large. And that's one of the big macro trends that we're starting to see. Nathan, any thoughts on the institutional capital flooding back into the office market? Was that surprising to you?
It's not that surprising. I mean, I would say as far as investments when it comes to office has mostly been, I would say when it comes to large scale class A office, it's mostly been the institutional players. I would say with the smaller office footprints, majority of those have been owner users when it comes to sales. So that it's not too surprising for me.
Yeah. Well, you're in the business on a regular basis. I imagine this is somewhat surprising for a lot of different folks, as office has definitely gotten hit pretty hard and taken some punches. But, like I always like to say, I mean, Sam Zell always was looking left when everybody else was looking right. And I think it was Buffett and Munger said, you want to try to zig while everybody is zagging. And this could be that opportunity. The second big macro trend that we're kind of capitalizing on today is the suburban outperforming the downtown, at least in our market. 73% of suburban markets show lower prime vacancy than the overall rates, right? And from a value preservation standpoint, suburban values are down only 7.5% versus steep downtown declines. And so you're seeing some big opportunities there as well. And additionally, I would say that from a tenant preference standpoint, right? Parking, accessibility, lower density, that's equaling, post-pandemic winners, right? That's kind of what we're seeing. And so, at least in our market here in Kansas City, like I'd like to say is that, the future of office isn't just downtown towers, right? It's accessible suburban nodes with infrastructure investment, right? We're seeing more and more amenities for these office buildings. Where can you be somewhere where it's a really cohesive place to be, and you can attract top talent and you can keep that talent, and they can keep them happy by having their gyms, their laundry, their retail, their restaurants around where they're working. Any thoughts specifically on that macro trend number 2 there, that suburban office continues to outperform a lot of these different urban markets that we've seen?
Yeah, I mean, I would say the trend in Kansas City is completely different than what you're reading in some of the headlines. I mean, the headlines are mostly really just showcasing what's happening in those primary markets. And normally it is the central business district office buildings that are performing significantly better than suburban. And that's just not the case here in the Midwest.
Yeah, that's a good point to be made. Real estate is hyper local. So ensure that you are talking with experts in those markets and getting past just the headlines. Well, getting a little more micro, Nathan, I'd like to kind of talk about some of the office investment and trends that we're seeing in Kansas City specifically. We had a pretty big absorption surge, right? We had 1.6 million square foot of net absorption. And I'm going to let you explain that here in a second versus negative net absorption in prior years, right? Our vacancy has been declining. So we're down to around 11.1%, which is down from 12% year over year. And then the construction pipeline, obviously, I mean, that's virtually zero new supply, right? And we had some major tenant commitments with Kiewit, about 177,000 square feet, Southwind, 108,000 square feet, choosing Suburban as well. And I'm pretty sure one of the largest leases of all time in Kansas City suburban market just happened over on the Asperia campus. And you might be able to speak to that, but I believe that was over 400,000 square feet. Was that correct?
I believe so. I mean, I don't recall which tenant that was, if I'm being cool.
But in regards to the absorption side of thing, I mean, I think Kansas City's market is showing clear signs of recovery and momentum, right? We've seen a remarkable absorption surge. We've got positive net absorption over the past 12 months, which is reversing that negative trend of prior years. And that's obviously contributing to declining vacancy rates, which have dropped, to 11.1%, down from 12%, and I think those are things that as an investor, you need to be thinking about in this asset class, right? So you have higher cap rates, you've got lower vacancy, you've got higher net absorption. Those are all things that are happening that could be a good tailwind. And I think you still need to be selective, right? I mean, office is very location dependent, right? All real estate is, but office specifically, right, needs to be in a really good suburban node. And so, I mean, you're not buying into a declining market. You're buying into the early recovery play in the office submarket with improving fundamentals that has institutional confidence and validation that we're starting to see right now. Average triple net lease rents are up to $23 a square foot, which I think is also very, very high just for the Kansas City market. And, cap rates in Kansas City somewhere around 10% with pricing about $116 a square foot. Now, you got to realize in Kansas City, most of our top office that is trading is going to be on the Johnson County side. And that's going to be, a little bit higher per square foot basis on the Johnson County side. If you would like to talk about, any of the different submarkets that are driving, the Kansas City area, make up Kansas City, feel free to reach out to Nathan and I. We have a report specifically on Johnson County breaking down every single one, all the way from Olathe to Lenexa to Shawnee to Merriam to Overland Park to Leawood. We've got a report that can kind of point you in the right direction. But South Johnson County submarket, this is, look, I mean, the Red Bridge location that we're going to talk about today, it's benefits because it's situated in one of the Metro's strongest submarkets, right? And it had a huge infrastructure multiplier. There's been over $65 million of corridor investment creating competitive moat in this area. If you drive up and down Red Bridge in South Kansas City, it is clear that the city is very, very much focused on investing in this specific area, which has spurred multifamily development. It has spurred some new office development, believe it or not, and it has even spurred single-family home development in this corridor. Thinking about vacancies, Midtown vacancy is around 9.4%. That's around the lowest in the metro area, right? And that tight vacancy creates a favorable environment for landlords and supports continued rent. We're just south of that and just east of some of these major, what I'll call leases that have been signed. So we are on the Missouri side here in the submarket, but this kind of gives you an idea of a little bit of those leases and those sizes as well. But suburban office, I think, is a really interesting play right now because you have generational pricing opportunities. There is a supply-demand imbalance in specific corridors. You have a tenant preference evolution going from kind of this really downtown dense area to some more of these suburban nodes with a lot more amenities. And we've had a lot of infrastructure that's amplifying the areas, making it more easy to be able to travel to, as well as do life around. And I think that's where the office really is starting to kind of move towards, right? And so I think that for Kansas City market outlook, we've got an economic foundation that is strong. We've got market fundamentals that have held up across just about every asset class. We have the suburban advantage that we've talked about, and we have a really strong investment climate. So, what I want to say before we jump into kind of our investment offering here with the Redbridge, 400 East Redbridge Road, 46,000 square foot office opportunity. Head over to Crexy and or LoopNet to find that listing. You can find it on our LinkedIn, as well as make sure you're on all of our newsletters so you get all of our emails with everything that you might need. But this is just a high level of what we're going to be diving into today. We've got immediate value creation. We got stable cash flow, and we have capital appreciation potential. All right. So there's a lot of opportunity in this asset class. Nathan, before we move into actually letting you present this opportunity and what we're working toward, did you have any more thoughts just on the macro trends and micro trends of the office submarket?
Yeah, I would say one thing regarding net absorption, really that's just the difference between what came available in a 12-month period and what actually got leased out. I would say majority of what's driving the trend or that increase in the rental prices is really the higher end class, A class properties. C class, even though C class has the higher vacancy compared to the different asset classes, it's staying pretty stagnant. So even though there's been a work from home trend with some of these lower end offices, you haven't seen a decrease in the lease rates there. So that's one thing that I just wanted to note.
Yeah, absolutely. All right, shifting gears over to our deal spotlight. 400 East Redbridge Road represents a prime suburban office investment opportunity in South Kansas City's supply constrained market. It's a 46,000 square foot professional building. It sits on about 2.3 acres with ample surface parking. It's going to offer you, the investor, immediate NOI potential growth through operational improvements that we'll talk about today, combined with durable income from a stable tenant mix. Many of these businesses have been there for 20, 25 years, right? So we've got an immediate value creation. There's $40,000 to $50,000 of annual utility savings that have been identified. We're being conservative there. I'll show you the PEA report here soon. But just at a 8% cap rate, that can immediately add around $500,000 of value to the property. We have a supply constrained submarket. There's no new construction pipeline. We have infrastructure beneficiary here. You have 65 million plus of surrounding corridor improvements, enhancing the accessibility and the demand. And you're well below replacement cost here. The acquisition is well below, 150 to $200 replacement cost, right? Depending on your office build out. So, we're very excited about this deal. Before I just give all the goodies away, I'm gonna let Nathan kind of talk through kind of this opportunity here and what we've got. But I just wanted to set the table for you.
Yeah, I mean, so you talked high level about some of the details with the property. It's 46,000 square feet office building. We're somewhat calling this a medical office building too, just because majority of the tenants there are a dentist use or dealing something with the medical industry. But the great thing about this building, you have about, I want to say it's 160 parking spaces, but you essentially have 4 parking spaces per 1,000 square feet. And this building is sitting on about 2.3 acres. I would say the best thing about this building is really location and just everything that's going on in that area with the infrastructure improvements that Logan mentioned. And right across the street, Lane 4 development has that retail shopping center. And I would say as far as foot traffic or street traffic counts, that's really bringing that demand to that area is that shopping center. There's so many different thriving businesses there. And I think for any owner that's coming in, you're going to have great visibility on that main frontage road.
Yeah, absolutely. The price is $2.9 million, puts you right around $66 per square foot. Current net operating income sitting right around $230,000. Our pro forma NOI, if you want to check this out, head over to Crexy, head over to LoopNet. Our full underwriting offering memorandum is available, but the pro forma NOI at 83% stabilized occupancy. Again, I said 83% stabilized occupancy. We just said that Kansas City's office vacancy rate or the occupancy rate is hovering right around 89%. So we are being a little conservative on the stabilized occupancy is $356,000. So there's really a big opportunity to add some value to this property. Man, I'm going to take this slide and just talk through some of the roads and streetscapes, man, because I live and breathe this corridor. This is my running route. I go by it on a regular basis, but man, the streets over there, the infrastructure, they spent over $50 million on this deal, right? And so that's just incredible. It's a complete streets project. We widened the streets. We got sidewalks. We got bike lanes. We've got lighting. We've got, some greenery even on Red Bridge Road. It's right across the street from Lane 4's shopping center where they put a lot of money. I believe it was close to $19 million into that shopping center. This $34.5 million probably has something to do with the Wonderscope project that was done, the new Farm Fresh market that was done, and or the acquisition price as well. Just across the street from that is Minor Park Golf Course and the Blue River Valley Trails system that I run on right in this area, right? So you've got all of this going on, and it's just an incredible time to be involved in South Kansas City. We're very excited about it. Here's the location, guys. So you can see we have great highway access from 435. You come up and down Warnall Road. You just go over to Warnall from State Line and hit Red Bridge Road, and we're sitting right there in the mix of the Farm Fresh Market, the Barrio, Crow's Coffee, a CVS, Sonic, Mama Leone's, where I go get pizza on a regular basis. That McDonald's is no longer there. So that is something that is a unique component. Not really sure what happened with that McDonald's, but it is vacant in that area. I'm sure something else is going to come in. I'm hoping for one of my favorite chicken restaurants to come down to the corridor. But there's just a lot of great retail and restaurants right across the street. So if you're a business looking for an owner-occupant deal, you have the opportunity to come in and you can grab some suites and move your business here. If you're an investor, there's a clear opportunity to be able to attract businesses to this site. Any other things that you wanted to talk about from the property's location here, Nathan?
Not really from the property location. You kind of hinted on all that.
Absolutely. So demographics, 1, 3, and 5 mile, right? Median household income right around $80,000. There's 21,000 households around here. Nathan, you would know this better than me, but there is not very many options on the Missouri side for investment in office and or just an office building specifically in this corridor. So big opportunity for that. You've got good demographics. Population is 50,000 in the 3 mile, 163,000 in the 5 mile. So there is no issue with any of the demographics from the standpoint of how many households or how many people or even the income in the area. Great location in South Kansas City. All right, moving on. You know what, Nathan? What have we talked? What have we missed so far in regards to the overview of the property? Because I know I've been doing a lot of talking. This deal just gets me excited and I'm just pumped up because I love it. It's right next to my house and I just see it on a regular basis.
Yeah, so the main thing that we have not discussed yet is the PEA. It's the preliminary energy audit, and that's really going to be the main value add component with this building here. It's primarily because with the energy audit, we have determined that the energy costs are significantly above what the average would be in that area. Right now, they're sitting at about $3.88 a square foot compared to about $2.10, around $2.10 for the average for the area. And based on that preliminary energy audit that we got, we have determined that there could be some significant cost savings with water and some of the energy costs dealing with electricity and the lighting. But there were a few plans that were kind of hinted at in the PEA for what you can do in order to get that energy cost down. And we do believe, based on some of the improvements that you can make, that we can save roughly about $40,000 a year, and that just adds significant value to that end buyer there.
Look, guys, I mean, the benchmarking has been done. It's between 350 and 388 on site right now. The benchmarks for similar properties hover somewhere around $2.12 per square foot, right? And so this preliminary energy audit has gone in. We've toured the property with this group, and they have put a plan together, and they believe that if these things are completed, that there could be really substantial savings. And Nathan, just talk about maybe some of the ways that this leases are set up, why this is so important, right? Because for a triple net lease structure, this could be still beneficial, but maybe less beneficial from an investment standpoint. But with the lease structures that we have here at 400 East Red Bridge Road, go check the listing out on Crexy, on our LinkedIn, get on our email list. Talk to us about the lease structure and why this is so important.
Yeah. So I'll start out by saying that this is a full service gross lease structure. I would say with the triple net, the reason why a triple net lease structure wouldn't be that beneficial for an owner is because all of the operating expenses are already a pass-through charge to the tenant. With a full service gross lease structure, the owner of the property, they try to account for what some of those operating expenses are. But if those operating expenses were to increase, a lot of the times they're still kind of paying that difference. The great thing about this is some of these costs, I mean, if you can bring those costs down, I mean, you're raising your NOI, number one, and that's drastically having a huge impact on the value of the property. We determined that, I mean, if we're assuming an 8 cap for the sale of this property, and we're able to sell, or we're able to save $40,000, which means that NOI has increased $40,000, you're essentially affecting the value, I believe, by around $500,000 in value, which is insane.
Absolutely.
40,000 divided by 0.08. Yeah, you're literally right at 500,000, which is insane.
Great. Yeah, absolutely, guys. There's 2 implementation pathways on the energy audit here. There's the conservative approach where you can spend around $162,000, and you're going to be working on getting around $38,000 back from the utility and $4,000 from the operating maintenance. Right. So that's a 22% utility reduction. The holistic program that's been laid out costs a little bit more. We're closer to $500,000, right? But annual savings could be up to $76,000, right? And so we would get our final reduction cost down around our utility cost about $2.17. So that is a 38% utility reduction opportunity across all the categories. This breaks it down here, right? So obviously electric's going to be the biggest one here at $72,000. You've got water, or you got sewer at $47,000 annual cost. Our water's at $23,000, and our natural gas is right around $30,000. So this breaks down the utilities. Make sure you reach out to Nathan and myself for this full report, right? But we found there were some HVAC system inefficiencies. We had lighting and controls that could be operationalized and upgraded. We had a water system issue as well, where we thought that there might be some opportunities to be able to create some efficiencies there as well. We've got a full implementation timeline right around 12 months to get this done. But here's that value creation, right? So like what I want to, and I got a little cherry on top for everyone here in a second, but look, you got year one cash flows of $42,000, right? I mean, even if you finance this, you know, you're still into the positive of $3,000, right? And that's paid for over that first year. So now that years 2 through 5, you've got a $42,000 annual free cash flow back to the bottom line, which is absolutely huge in regards to an investment of this size to be able to add $42,000 of NOI. If you go to the holistic approach and getting $76,000 back on your NOI, yes, this might cost you around $500,000 to do. There are rebates and deductions through the 179D program that we can walk you through, but that would be a $950,000 increase. So that's the cap rate increase. It's almost $1 million of value created, right? So that is a big opportunity for the next purchaser here. This just kind of breaks down that conservative approach in the year 1, 2, and 3, in the 10-year value creation on the conservative approach and the holistic approach on the value that can be created. We got this all broken down, but we're not going to stay there. This is a critical update. Okay. Look, the 179D program, and we can spend a lot of time with anybody who's interested in talking about this, but the 179D program allows you to take a full deduction, which is achievable if you use prevailing wages and an apprenticeship program, and you have the Evergy utility rebates, right? This is going to be able to get the holistic approach down from that $500,000 investment all the way down to $353,000, right? So we've got $116,000 kind of depreciation from the 179D, and you have $28,000 worth of rebates through the Evergy utility rebate program. So that true payback period with the holistic approach utilizing both of these is around 4.7 years, which is a 21.5% cash on cash return and a 483% total project ROI. Okay. So we've got the full report available for all of you all to review. The way that this would work, let me go back to this implementation schedule. So we do the preliminary energy audit. Then you go through an investment grade energy audit where we're actually going in and we are bidding out all of these upgrades for you. The company is, and then we're getting that investment grade audit phase completed, and that's completed now. And then you're implementing this process. So this could be a lot faster than that 9 to 11 months because we've already got this first phase, months 1, 2, and 3 already completed, right? So we would just need to have the new buyer start the investment grade energy audit and move on to getting that bid out and then implementing that over the next couple months period. So big opportunity here in regards to the energy audit findings. We believe on a conservative approach, there's around $500,000 of value. If you go with the holistic view and you're going to hold this property for the next 10 years and or you just see the opportunity for those rebates and those deductions to the 179D program, you can add almost $1 million of value creation out of 8% cap rate back to the property. So this positions the property for measurable net operating income boost with limited capital outlay, likely things that you're probably already budgeting for in a building of this age and of this size, and you would have that in your budget. You can take advantage of those rebate programs and what's going on right now before they go away. So going through, let's just take a look at some of the vacancies in the floor plans here, Nathan. So walk us through some of the floor plans, the way that this property is set up. How many suites do we have, and what's the average size and some of those vacancies?
Yeah, I'm not sure exactly how many suites are in the building. I do know that the average size is around like 14, or I would say 12 to about 1,500 square feet, which is like, I would say for office buildings in office space in general, like if you have spaces that are less than 2,000 square feet, those are getting leased up very fast compared to anything that's going to be over 5,000 square feet.
Absolutely. So we've got the vacancies here outlined on our flyer. You can find the flyer on Crexy, on LoopNet. It's available for you. We got 3 pages of the floor plans and the vacancies here. You can see the way that all of these are set up and breaking down. So the investment highlights, and then we're going to get into some questions here. Got your immediate NOI growth. And we've talked a lot about the preliminary energy audit findings, but additionally, we're at 75% occupied. So getting up to 83, 84, 85% occupied, that's going to create, a measurable boost in NOI here. And that's not a ton of square footage, right? You go grab and lease up 4 or 5 of these spaces, you are now operationally stable at this investment opportunity, right? So there's definitely an opportunity just on the lease up side as well. We've got a supply constrained submarket. We've talked a lot about that. We're well below almost a third of replacement cost here for this asset. And we're in a strengthening neighborhood. Nathan brought his drone out, got a beautiful shot. One of my favorite shots to the property here. Fantastic job with the photography here on this photo. But you can see the beautiful shopping center behind it and kind of Red Bridge Road and even Minor Park Golf Course out there in the background, as well as CVS Pharmacy. So really have an awesome opportunity here for a value add. And I'm like Nathan said, there is a lot of medical tenants here, but we're not really calling it a medical office building. But there are a lot of dentists, a lot of professional services here on this asset. If you are interested in learning more, make sure you go over and check out all of the information. We have more information, a full rent roll, the financials, and a full underwriting in Cruxy. Sign that CA, get to the due diligence section and sign that CA, or you can contact myself or Nathan for more information. Okay, Nathan, we've got a lot of questions around the weighted average lease term and sort of the analysis on the WALT. So let's just go through this a little bit. So from 2025 to 2029, you can start to see some of those lease expirations, right? And we have a full breakdown as well of each one of these businesses and kind of where they're at. Either they're renewing or they're in talks with renewal with the current ownership company. Happy to share that information with you guys as well. But 2026, there's quite a few of expirations coming out, right? So you can view that one of two ways. Obviously it gives you the opportunity to come in and raise rents and, bring these up to market and put some money into the property if you think that you should. Or you can renew these folks, right? And just have those conversations. But what we like to see is there's at least 10 to 12 in the next 12 to 24 months that you're going to be able to have conversations with, right? So you're not locked in here on this asset for the next 5 years and everybody is set in stone, right? So you have an opportunity to be able to come in and do some negotiation and some working, right? So we have a few of those tenants on month-to-month leases. Some of these have been updated, so we have some more information around that as well. But look, our WALT calculation is right around, and this just breaks this down into a graph, right around 2.1 years. What does that mean, Nathan, for the next purchaser?
Yeah, so that just means the weighted average lease term. So that's important when it comes to number one, financing. Financing is definitely going to be a huge play when it comes to what is the average or the average length of the leases in that building. I would say, and one thing that we didn't necessarily hint on, but we talked about briefly, was that the average lease rates in this area is about $21 a square foot. This building in particular is sitting at around $15.50 a square foot. So definitely below average, but definitely there's a value add play there. So if you were to go in when some of those tenants are turning and you're able to just pretty much increase the update the office finishes, you can charge more in rent. Like the comparable properties they're also 80s vintage. They're not too far down the road. They're still roughly going to be around that 40 to 60,000 square foot range. And those are going for $21 a square foot. The only difference would really just be the office finishes. So if you can update those office finishes, we pretty much can bet that you can get more than $17 per square foot.
Absolutely. That's a great point to be made here, guys. Opportunity here for a lot of operational change in regards to the negotiation with the leases, the upgrades of the building. That can drive a lot of opportunity if you keep it at the same level. And you'll see this in our pro forma, but our same level of rental rates of $15 to $16 a square foot and simply lease up 5,000 to 6,000 square feet, you are now to that 83, 84% occupied, and you're driving that NOI growth and a pro forma cap rate above 10.5% here. You pair that alongside the opportunity for the utility savings. So now you've added another $25,000, $35,000 in rental income. You've added another $40,000 to $50,000 in utility savings, and your NOI, you can see how we can jump from $230,000 of current NOI to $356,000 of a pro forma NOI rather quickly. And there's a clear business plan to get it towards that. Okay. We got a question in here. Can you go ahead, Nathan?
Yeah, I was going to say with a lot of the OMs that you see, majority of them are going to be very aggressive on the lease up, what you can get the lease rates and everything up to. We are being very conservative. So with these returns that we're anticipating, we do believe that if you were to do slightly above what we're saying you can do as far as returns, like you're going to blow these returns out the water.
Right. Yes, absolutely. Absolutely. I think the 2.1 year WALT positions this property definitely as a compelling value add investment opportunity. It offers an attractive entry point for experienced owners that have holdings. They understand this business, this asset class, which presents significant upside potential through a strategic releasing at market rates, securing some longer term leases, adding some value in regards to the build out. Additionally, working on the mechanical, electrical, and plumbing systems that we've already talked about. Nathan, we got a great question in here. I'm going to put it up here on the screen for us. Can you walk us through the tenant mix and any lease rollover risks? So let me go back to our weighted average lease kind of calculation here so you guys can take a look at this. But yes, here's our kind of lease expiration. So 2025, we've only got a couple. 2026, 1, 2, 3. Abbey Construction, I can tell you, they've already renewed. So they are staying. Okay. So we won't count them. 1, 2, 3, 4, 5, 6, 7, 8, 9 expirations in 2026. 2027 kind of tapers off. We've got 3 in 2028. We got another 7 in 2029. There's only 1 lease expiration. But in regards to the tenant mix, Nathan, can you walk everybody through kind of the types of businesses that are currently in the property?
Yeah, so there's dentist groups, there are some insurance groups, there's attorneys in here, there's like more mom and pop type of businesses dealing with like skincare, there's construction company. I would say, as far as the lease rollover risk, with a lot of these medical office type of uses, I mean, they've been there for over 10 years at this point. We don't foresee these tenants just upping and moving their business, primarily because a lot of physician offices or medical use in general tends to be location specific. So there's a few other properties in the area that these tenants go to, but the reality is majority of the medical office tenants tend to stay put once they find a great location where their customers are actually coming to. So I would say the rollover risk is fairly low, even though the weighted average lease term is only about 2.1 years.
Yep, absolutely, man. 100%. Well, let's just get into a little bit of the executive summary again. This is on Crexy. This is the full offering memorandum that is available for you on our listing. But you can see we're right around an 8% cap rate on today's metrics. The pro forma, I misspoke, is not 10.5%. It's 12.26%. You can get close to a 12% cash on cash return. And I do believe in the pro forma, we only dropped the operational expenses around $10,000. So if you're able to go get $40,000, $50,000, $60,000 of operational expenses kind of removed and or reduced, this is going to be even more advantageous for you. But I do want to show some more of the pictures around the property because I think that you did a great job with the asset type and the drone and videography. We don't have any videos ready for you guys yet. Those will be coming out soon. But you can take a look at the property and get a real good feel for it. Question around the cell phone tower. It is leased to T-Mobile right now. And if there is a renegotiation of that period of time while that lease is in place, the new ownership group will be a beneficiary of that. And the solar panels on top of the roof, yes, they are adding value and they are operational right now. So there is that kind of component going on. You can see massive parking lot, right? And so one of the things that we've long thought about on this asset is, could this be positioned for redevelopment at some point? And I absolutely think so. You know, you're sitting on 2.3 acres in an area of Kansas City. You can see some of that infrastructure work on the left side of our screen here. You can see the streetscapes, the sidewalks, the widening of the streets. Just beautiful area here on Redbridge. But look how big that parking lot is, right? Just a massive parking lot. It is good to note that the elevators have been updated. So we've got a lot of questions around the elevators, and the elevators are operational. They have been updated. They were updated last year, full new systems. That roof is about 16 years old right now. Okay, guys? So about 16 years old on the roof. It's in good condition right now as well. Look at that beautiful golf course just down the street of Minor Park, right next door. So this is some more asset type pictures, but here's a great photo. So Redbridge Road office building on this photo is on the right side of our screen in the back. This is a picture of the area of the gas station of Lane 4 shopping center. You can even see Wonderscope, where my kids frequent on a regular basis. Lane Ford did a great job with that building, dedicating that to the city and working with them. To the left of the screen, you will see the new Farm Fresh shopping center, actually the grocery store, which is not shown here, but this does a phenomenal job of the $65 million worth of infrastructure work on these roads that was going on. And I know I've been harping on this a lot, but like if you were here, a couple years ago, this did not look like this, and it was not this nice. So this is absolutely showcasing the area and how well it is doing and attracting new businesses. I do believe this shopping center is dang near 95, 100% occupied at all times. So it's doing phenomenal as well. So this just gives you some more pictures of the property, the insides here. Like we said, you have the opportunity to bring your vision and your upgrades and push those rents potentially from $15, $16 all the way up to $20, $21 per square foot with some upgrades of the office building itself. Okay. Fantastic job here, Nathan. Just really great job on the photography. This does a great job showing you guys what's around the area, but we have talked a lot about that. 140 surface parking spaces. And how does that compare to the tenant needs? Well, I'll tell you, there's a lot more parking there right now than is utilized, right? And so you have the opportunity to even think about doing something different with that parking. Okay. So I think that's a great opportunity for you as the investor as well. Look, I think that we've got one more question here. You know what? I'm going to put this up on the screen for you, Nathan, because I'm going to let you take this. Parisa is doing, he says, this is amazing. That's awesome, man. Thank you so much for being here. We very much appreciate you. Yes, if you'd like to learn more about these types of value add opportunities you can work on, definitely reach out to us, man. Absolutely. You talk to investors who are looking to buy these value add assets on a regular basis. Well, we're your guys here in Kansas City. If they're invested in Kansas City or interested in Kansas City, we'd love to talk with you. All right, Nathan, good question here. Putting it up on the screen. How do you view the competitive landscape for tenants and businesses in this area?
Yeah. So, I mean, I kind of hinted on this, the fact that there's a few office buildings around there. I would say there's less than probably 5 office buildings within that submarket that are more than 30,000 square feet. The ones that you're competing with is really going to be right next to 435 Highway, and it's very comparable when it comes to the actual age of the property. As I mentioned earlier, really the only difference is going to be the interior office finishes. And like I said, if you were to just increase some of those office finishes, changing out some of the outdated carpet or the fluorescent light bulbs, changing that to LVP or LVP flooring and some sort of LED lighting, I mean, you're already going to increase rents that way. Another thing that a lot of office tenants are looking for amenity wise is just having some sort of kitchenette within their suite, and that's fairly easy to add depending on like where it is relative to the nearest restroom or main water pipes and things like that. But that's just an amenity that these tenants are looking for. As you can see, based on the facade of the building, you already have a lot of windows on the exterior, so you're having that natural light coming in. That's not really going to be an issue because there's already a lot of those windows there. But I would say as far as competitiveness, I mean, there's only a few other properties in that area. And I think just by doing some light renovations, you're able to increase that lease rate there.
Absolutely. Guys, on the underwriting, we have 40 units, 45,832 square feet. You can see that the rent roll fully occupied currently. We have at 828. That's an annualized basis, $890,000 on the pro forma. So not really adding all that much, rental rate. So we're being very conservative on that. And it still pushes from an 8% cap rate all the way up to 12% cap rate. And so there's an opportunity through occupancy, rental growth, and the preliminary energy audit findings that we've had. We don't have time to go through the full operating stats and the pro forma, but all of this projections, and all of the full underwriting is available on Crexy for us, for you to review. And we'd be happy to walk you through any of that information. Look, we're going to just kind of end up here. Let me share a new screen for us. Look, we've talked about 3 to 4 to 5 different ways that you can have immediate NOI growth. We are not experts necessarily with these preliminary energy audits, but we're not novices either. We've done these on other properties and can help navigate that conversation with you. We're in a supply constrained submarket. This is well below replacement costs. We're in a strengthening neighborhood. Suburban office is getting a lot of institutional interest right now. Kansas City's office vacancy has dropped from 12% to 11%. We have positive net absorption of 1.2 million square feet. There is a lot of tailwinds in regards to this asset class and this location. All of this information, the flyer, the full offering memorandum, the weighted average lease term calculation, the underwriting, the market report, all available to you. Just reach out to myself or to Nathan, and here's our contact information where you can do so. All right, so Logan at mwcreadvisors.com, Nathan at mwcreadvisors.com. Yes, we both have 573 phone numbers still, repping Columbia, Missouri, Jeff City area. All that due diligence information is available to you to review. I'll tell you, we launched this deal, listed this deal about 3 or 4 days ago, and the interest level has been extremely high. We're very excited about this asset class. I think it can be a real trophy for somebody that is interested in the South Kansas City submarket in a fantastic area that has experience with this property type. We're excited about it. Please do reach out to us. Nathan, what questions do you want to address before we sign off here? Or what did we miss today?
Not really too much. I will say, I mean, we talked about this from the investor perspective, but I think this could also be a great building for an owner user too. Someone that's looking for, let's just say 10 to 15,000 square feet, but also want to have some of the upside when they do decide to sell years down the line. This would be great for an owner user.
Absolutely. Well, all of you, thank you for your questions, for your comments, for showing up for another Kansas City Commercial Real Estate Market Pulse edition, another deal spotlight. We've been busy. Reach out to our team, Nathan, myself, Chad, Nick, Katie, Micah, for any needs that you have in regards to 1031 exchanges. If you're looking for an investment opportunity, if you're looking for a development opportunity, we've got the projects for you. We'd love to meet with you. Here's our contact information. Make sure to give us a follow over on LinkedIn. We're bringing these deal spotlights. We did 2 last week. We did 2 Market Pulse editions last week. We're here with 1 this week, but I'm sure we'll be back again for another one here shortly as we have more listings to be launched. So thank you all for joining us for another edition of the Kansas City Commercial Real Estate Market Pulse. Go get the more information on the Crexy or LoopNet, or reach out to Nathan or myself for the 400 East Redbridge Road, 46,000 square foot office building in suburban Kansas City, South Kansas City, my backyard. I know the area. I know the asset. I'm happy to be talking with you about it. Very excited about the project. We'll talk soon. Nathan, thanks for joining and thanks for being here. Appreciate you guys.